Hey, Go Invest subscribers and investors. Today we are talking about Go Invest 201, the new course that I'm putting out there for introductions to options trading. It is bare bones beginners. We're not talking about strategies until 220. So Go Invest 220. This is currently Go Invest 201. So if you have absolutely no idea of what options trading is, this is the place to start. Today we're talking about call and put options. All right, without further ado, cue the intro. Okay, guys, so we are talking about lesson 1 of Go Invest 201, which is calls and puts. So, huge disclaimer here, guys, for options trading can lose you a lot of money, and I can't be held responsible. Can't be responsible. So this typically, the reason why I'm saying this is it's a tool in your tool belt of trading, and I do want to give you guys these tools like it's like, say, a weapon. All right, you get to use it, but it can do a lot of damage, so you better use it right. So it's a tool, but you can shoot yourself in the foot. So I'm saying that use it cautiously. And options trading is essentially the gambling of uh, of Wall Street bets. All right, and the idea here is majority of people lose. A few people are winners. A few people have made consistent gains, but the majority, like let's say if 97% are losers, 3% are winners. And the thing is that media and everybody online really likes to highlight the winners. So you think everybody could be a winner, but that's just not true. They're huge losers, and you just saw us lose a ton of money on an options contract. So we made a ton of money, but we also lost a ton of money on an options contract. So use with caution. And That is disclaimer. So you are technically gambling on the price of stocks. Now there is a way to explain it, which I will, to kind of mitigate that truth, to kind of like downplay that, like, oh no, sugarcoat it. Basically, it's not really gambling, but to any sane person, you are technically gambling. If you can make 3x, 10x on your return on your investment, but also lose it all, you know, that is gambling. And so this is what I would say. Like, say if you just did normal stock trading, you might make 5 to 10% per day. You may lose 15% on a bad day. Here you have a chance of losing it all, even in the matter of a day. So very, very risky. And I'm suggesting that this is something that you learn from the beginning. You understand your risk tolerance and your risk management. So risk tolerance, what kind of risk can you handle? So some people can handle a lot of risk. They have the high tolerance that they can break into somebody's house, or you know maybe be a serial murderer or some other type of crazy thing, but not like they have that tolerance. But the thing is that if they get caught, of course, they could be put on death row. They could be put away for life. It's possibility, and they did that according to their tolerance. They thought that that was something that they could handle, but they didn't take into consideration the negatives. You must be okay with both making a lot of money and losing a lot of money and losing a lot. If you are to go down this options trading route. And then the other thing is risk management. So if you realize that you cannot lose a ton, then you have to put safeguards in place. And in fact, over here, we will enforce the safeguards. Like before, I didn't really enforce the safeguards. We were trading, on the Bollinger Bands, not really looking at, the fundamentals of the company, the news of the company, where it is zoomed out and all these other things. Here in this class, we will be looking in those things because everything has to play a factor. If you are gambling, you better know the odds. Okay, you better know the odds of you winning or losing. So now let's talk about options in specific. So let's go to the history. So majority of this stuff used to happen in the commodities market. Let's see, like coffee beans or corn or some sort of commodities. I don't even know how to spell that. The history of commodities. And let's say a farmer who has a farm basically gets a lot of crop. The only problem is he doesn't know, one, if the crop will be there. There might be a huge famine or something that kills off the crop, or there could be, he doesn't know the price at sale. But he knows this year it was selling for about $2. Okay? So what he wants to do is he wants to ensure that he can get $2 for his value. So what he does is he knows he's making 100,000 pieces of crop. I don't know what it would be. It would be corn, it would be coffee beans, it would be gold, it could be any commodity, basically. And so it's farmer produce, tomatoes, potatoes, anything that you can kind of think of that you can make in a farm, maybe peppers, watermelons, whatever. So you got 100,000 pieces, and what you do is you see a businessman here, and you give him a piece of paper. It's a contract. He says that for a premium of $10, I'll give you a piece of paper that says I will sell you 1,000 pieces at $2 each. So 1,000 pieces at $2 each, and then there you fixated the price for 1,000 of your pieces for $2. So and then you got this 10. So you have 100,000. That's 10 times 100, and you've made $1,000. So you fundraised $1,000. This can help for your farming efforts, but for the other guy, basically what he's doing is he's betting that the price will go up. If inflation hits and the price goes up to 2.5 when it comes summertime and you are to reap your crop, then what he can do is he can say, look, I have this contract to buy 1,000 pieces at $2, so we can say that he'll profit 1,000 times the difference, which is 0.5, and he will make $500 basically in terms of profit. So for $10, he made $500. But again, it was a bet because the price when it comes out could be $1.5, and in which case he'll have to scrap that piece of paper and lose his $10. But for somebody, the $10 may be way worth the gamble because you can make 500 off of that $10. So here's the other problem is that once this happens, a lot of other people are seeing it. A lot of other people are seeing that $10 and they're like, whoa, is that a good deal? Let me buy it up. So they'll buy up the $10. The $10 will go up in market value. This guy will say, why not sell them for $15? If there's so many people buying them for $10, they'll definitely buy it for $15. And what you have is a demand and supply graph for the contract. Okay? That is like the basic history of what an options contract is. And every contract has two things: a strike, it basically, actually three things: strike, status, and expiry. So this can only be used for that particular summer. It can't be used for next summer or the summer after that. It'll basically expire. And when it goes down to like 1.5 and the guy scraps his contract, that's called expiring worthless. Worthless. Okay, so what is the strike? The strike here is the price, that $2. So $2 strikes. Okay, so that's what your strike price is. This is also used in gambling. If you're trying to say a team wins by 7 points, that points is a strike. If it goes above that, you're still winning, but if it goes below that, you're below strike. So it's something similar to that. Status could be both a put and or a call. And a put is an option to sell contracts at price, and a call is to buy a contract. And we'll go into this a little more detail in another slide, but that's what I want you to know, that every options contract has a strike, a status, and an expiry. Now, they also have something called Greeks, and intrinsic and extrinsic value. We'll talk about that next time. And that pertains to the market that contract belongs to. So now it's opened up a secondary market. Instead of just you trading on the stock itself, you're trading on options for the stock. So you're basically trading on metadata. It's basically meta. So like imagine you have a Facebook feed within a Facebook. It is meta. That means you have the one thing and then you have a thing inside it. It's inception. So you can keep trading like that. So somebody could trade, like say, a house, and then he can bundle the house into a security and then trade the security. And now that becomes meta because it is, you're not trading on the properties anymore. You're trading on pieces of paper that imply the mortgage or the debt on a property. So this is the meaning of meta. So a contract is meta to the thing. It's basically turned that 1D time frame of a stock to either betting the stock goes up, the stock goes down, or and then it goes laterally in time. So there's factors. The expiry affects it, time to expiry, because let's say it's early in the stock. It has a lot of movement. But as it goes forward, the movement narrows. It can't go that far if you're trading on the Fridays and expires on the Friday. Whereas if you trade on the Monday, during the whole week, it could have gone crazy high, it could have gone crazy low. There's a huge more variability to it. So expiry time makes a factor, the strike makes a factor, and whether it be a call or a put makes a factor. So I said kind of the call is the option to buy at a price. And what usually this means is that, say, it's usually talks in units of 100 shares is one contract. Okay, it's one call contract. One call or one put is always in units of 100 shares. Okay, so if it's in units of 100 shares, what do you have a buy it price? So currently, let's say it's trading at $27.19. You can buy it for the 27.50s, and you buy a call. And say that call is worth 70 cents. Okay, so you have this as premium. That's what you're paying for the contract. So to break even, not only does the price have to go above the 27.50, it also needs to go above your 70 cents premium on top of that. So your break even price, break even is 28.20. 7 plus 5 is 12, and then you carry over the 1, 28.20. So unless the price exceeds this, then you're in profit. And this is intrinsic profit. All right, there's also a hype factor that's not being considered here, because you can resell this contract at another premium to somebody else. All right, so the premiums increase as well as it goes more in the money. And we'll talk about these terms in the money, out of the money later on. I think it's simple enough to talk about them, but I do want to dedicate another video to intrinsic and extrinsic factors because there's a lot of things that play on with them, including the Greeks. And maybe I might do the third video on the Greeks, the second video about in the money and out of the money. And so this is just about calls and puts. And then you get the option to sell or you get to buy or sell calls and puts. So this is the video all about that. We're not going to talk about in the money or intrinsic or extrinsic value at the moment. But basically know that if you exceed the strike price and the price of your contract, you're making some profits. So let's say it goes to 29.20. So how much are you making? You're basically making as if you owned 100 shares. That's how much it's going up by. So you basically, so assume that you had like $100. All right, so say you had $100. You could have bought 3 of the stock trading at 27.19. You can buy 3 times of that. So you're basically, if this goes up to 29.20, we subtract it from 27. Let's just say it was 20. So it went up $2. You have 3 shares. You basically went up $6. All right, small fries. But say that you had $100 and you popped it into an options contract at 70 cents. So basically, you're buying 100 at 70 with the contract price of 70 cents. So what you're paying is $70. You're paying $70 for one contract. You have $30 of buying power, and you have one contract. But understand that one contract, once you exceed this 28.20, you're making as if it was 100 shares, and you're up $1. So you're making $100. Not only are you making $100 intrinsic, the strike prices, because these are now more stable, not a gamble anymore. So if it's not a gamble anymore, then this is also gonna be worth, let's say, $2.70 a premium, okay, or maybe even 90 cents a premium. So not only did you get your $2 here because it went up $2, you also got 20 extra cents because people are gambling on it going even higher. So that's your extrinsic. And you've turned, instead of you making just profiting $6, you instead profit $120. So it really powers you up. It gives you 100 times leverage, after the strike price, of course. You have to hit the strike price. That's the big caveat to this. But and part of the strike price is they price it so that you have this window. And you have to hit those things before you start making money. And then even then, you also have a break-even price. And then you have to go below that or above that. So those are the big caveats to it. And as you go closer to expiries, this 20 cents becomes near negligible. However, if you are still in the money, if you're still above the strike price, you will get that $100. It's almost guaranteed. All right, so now we talked about call options. We talked about the history of options. Okay, so I want to briefly talk about a put option here. And it's a little more complicated than the call option. And the reason being is because, like, say if somebody wanted to buy stock, it's just so easy, it's just a 1 degree. But to be able to play the negative, so that's to play the positive, to be able to do this, you need to be able to borrow a share, borrow, sell at market. Then as it goes down, you need to rebuy and return to be able to play this negative. Okay, so it's the same thing when it comes to put options. Is somebody sees their stock and they're like, well, I could sell options to a person to buy 1,000 pieces for $2. But what if I wanted to reduce liability? I think that the price won't go below 1.5. I don't think the price can go below that. Okay, so I'm gonna sell, or I don't think the price will go below 1.75. So I think that'll hold at least 1.75. So guess what? I'm going to give some gamblers, some business people who have a lower opinion of this than me. Somebody thinks that there's too much supply in the market, that the price will go down to maybe 1.25. So he wants to buy the right to sell 1,000 pieces. 1,000 pieces for 1.75, because he realizes if he has the right to sell pieces at 1.75, then and he thinks that the price will go to 1.25, then he can make money on the downside to the tune of 50 cents. 0.5 cents, just like in the last case. If he's selling 1,000 pieces, that's about $500 of profit right there. But this guy didn't. He has 100,000 pieces. He gave this guy the right to sell, not thinking that it would go below that, so he gets a pocket free premium. He didn't even have to. He gets profit free premium, let's say $10 a contract, and then more people are buying it. But the thing is that if the price holds above this 1.75, say it goes to $2 or something like that, or it still sells at the normal $2, then guess what? These people who have the right to sell it at 1.75 will not execute their things, because why are they selling it below market value? That means they'll have to buy 1,000 pieces at the market price of $2 and sell it for 1.75. It doesn't make sense. However, if it was below it, because this person sold the contract, he has the liability, in his case, to take on that problem. So now he sold the contract and it comes due. These people execute, they exercise their options. Say if it goes down to 1.25, they exercise their option, and this guy has to sell it to them at market value, which is 1.25, and then buy it back from them at the 1.75. All right, so even though they had the option to, this guy did give them the right to sell 1,000 pieces, and he would assume the responsibility for buying it back at if it was lower than that. Well, they executed it, and they buy it from him at the market price, which is 1.25, and they sell it back to him at 1.75. So now he's down. And just like selling stock at market value or something like that, this guy could have done it a ton. This person could have borrowed a ton without a lot of without a lot of cash in their portfolio. There's certain requirements to doing this type of margin trading, but similarly, a put option is just like that. It is a contrived way to play the negative. Okay, and so now you have both a positive call option and you have a negative, and some institutions do both. They hedge both sides. So they provide the market pressure to buy it up, and they sell these contracts at these prices. All right, and they have contracts and agreements in place to sell these contracts, and they'll assume the liability only for that premium. And they have strong calculations to figure out what this premium is worth and all of that stuff. So to be a market maker, you get these slight margins here and there that you get to keep for the ability to provide all these options for traders. So this is the payment for order flow method. And really, it's just saying that I will be certain third parties in a brokerage take on the liability of becoming that market maker, providing these options for people and becoming the farmer in this sense. They sell both the call options and the put options, and they hedge this liability with strong algorithms as to make sure that they eke out margin. So it's a contrived way of playing the negative is a put option, but it still works, and you can, as a trader, you have the ability to do both a call, which is a bet on the positive side, or a put, which is a bet on the negative side. So that's what a call and a put option are. And you see here that a company will have an options trade. You see this right now. It's Ford is trading at 14.93. You have 14.5, 15, 15.5. You have the bids and you have the asks and you have the latest price. It seems like the latest price for the calls went down by 20%. And you have like 12,000 people buying up this contract. And so this is your strike price. This is the price of the contract. So right now it's about 8 cents a contract. So you buy it for $8 each. So say you had $80, you can buy 10 of these contracts for the 15.5s. And it does look like it's a holding above Bollinger Band. Whether it goes down a little bit before it comes up, is anyone's guess. But that is like it's another week that's going to come by, and it's already above upper Bollinger Band, so it could do a small retracement back to the mid Bollinger Band line. Um, but that's what I'm saying is basically you have a new ask and bid that is pertaining to that particular contract at the 9th of July expiry for 8 cents. So here's your strike. This is on the call side, I believe. You have the puts over here, the calls over here. So this is the call side. This is your expiry. This is your strike. And this is the cost of the contract. So your break even will be 15.58. If it exceeds 15.58, you're in profit. And that's what the skinny of contract is. I hope you guys learned something about options contracts. I hope you guys, play responsibly.